Hey there, Ridgely Goldsboro here with Hardy Schmansky and Company, and I'm delighted to be joined by a couple of experts from our tax department. First, David Tribbett, who is a tax manager, and Michele Graham, the vice president of our tax department. And we're going to talk about what can you do now that 2023 is ended, we're going into 2024 to really take care of all of those details regarding your taxes. And David, we're going to start with you. What can taxpayers do? 2023 is over. We're in 2024. What do we need to worry about? What do we need to be thinking about?
As we begin 2024, start to gather all your 2023 tax information. You'll soon start receiving your W-2s, 1099s, K-1s, and other tax documents. Have a folder or file on your computer where you can accumulate all this information. You should also pull together your 2023 charitable contributions, the estimated payments you've made throughout the year, and any other information you may have put off tracking in 2023. Additionally, since meals are no longer 100% tax deductible, it's a great idea for businesses to review their meals account, carve out any company events such as holiday parties or picnics, since these are still 100% tax deductible. As you're doing this, you may realize your taxable income is higher than expected. There are still things you can do to help lower your 2023 tax liability.
Great. All right, Michele, over to you. What if your income is higher than you anticipated? What can we do in that case?
Ridgely, one of the most common ways to reduce taxable income is to contribute to an individual retirement account, also known as an IRA. If your income exceeds the threshold to make a deductible IRA contribution, it still might be advantageous from an overall financial standpoint to make a non-deductible IRA contribution before April 15th. For example, if you are under age 50, you are eligible to contribute $6,500 to an IRA for tax year 2023 and another $7,000 to your IRA for tax year 2024. Once April 15th passes, you lose the opportunity to make a 2023 contribution, meaning you'd only be eligible to make the tax year 2024 contribution, and thus have less opportunity to put additional funds into your retirement account. Making a decision and talking with your financial and tax advisors before April 15th will allow you the most flexibility in the amount of the contributions that you would like to make. If you own a business and you have a retirement plan in place, you have until the due date of your tax return, including extensions, to decide on a final contribution for certain aspects of the return. For example, if you have a 401k plan, you may have a mandatory employer match that is contributed throughout the year or even at year end in some cases. This amount is often a fixed contribution rate. However, your plan document may also allow an opportunity for you to contribute to a profit sharing plan. This amount can vary from year to year, and you have the ability to decide all the way up until that due date of the tax return, including extensions, which could be as late as this fall, like September 2024, to decide the amount of the contribution and also fund it. The benefit here is that you have the ability to have hindsight of your taxable income, as well as cash flow planning needs for the current year.
Are there other considerations a business owner might want to focus on regarding taxes?
Yes, Ridgely, there are. If you're an accrual basis taxpayer, there are some key accruals that have an opportunity for tax planning. Some examples of these are accrued wages, bonuses, or accrued vacation. If these accruals accounts are paid by March 15th, they can still be deducted on your 2023 tax return.
Michele, over to you again with a question about this thing called the health savings account, or an HSA. How does that work? How much can someone contribute, and what are the benefits of doing that?
Ridgely, a health savings account is an account that allows you to put money away for current or future medical expenses. This is another way to reduce your income after year end, as you have until the due date of your tax return to make these contributions, in the same way that we have until the due date of the tax return to make contributions to your retirement account. Contributions for self-only coverage for 2023 can be up to $3,850, while if you have family coverage, that limit increases to $7,750. For those taxpayers who are age 55 and older, There's an additional $1,000 catch-up contribution that is allowed. These contributions roll over from year to year, which is an effective way to use the funds in a future period if you don't have medical expenses to offset those currently. Making the contribution by the due date of the tax return still allows you to make a 2024 catch-up contribution later in this year, assuming you're still a participant in an HSA eligible health plan.
Thank you. Now, is there any last thing that you might want to leave our viewers with as we close this out, Michele?
The last reminder I would share is that fourth quarter estimated tax payments for individuals and trust are due by January 16th, 2024. It's important to ensure that these payments are postmarked by this date and sent via certified return receipt for both tracking purposes and to be counted for the 2023 tax year as paid timely.
Thank you, David and Michele, for that valuable information as we are in 2024 now and preparing for the best possible results when it comes to our taxes. We deeply appreciate the insights. And again, thanks so much.